Plummet Airways Limited leases an aircraft for 5 years. So we've got a lease term. Lease term is 5 years. We've got a date from ABC Bank. The fair value of the aircraft on inception is 100 million. Lease payments are so we know the lease term, we know the fair value, we know how much we're paying. It's a good idea. Sometimes you'll see there'll be an upfront deposit on it. Sometimes there'll be other payments kicking around. So just keep an eye on just when the cash flows happen. So that's your task when you get something like this is look, what are the cash flows, when do they occur? In this case, it's relatively straightforward. We've got lease payments, 5 of them in arrears, and there is a guaranteed residual of 50. The rate implicit is 7.5%. I'm not ordering this in any particular way, just I've got your room. The life is 20 years and a 0 residual at the end of that, and they expect they will keep it. So we've got, okay, life 20 years, 0 residual. So in a sense, we've got 7 pieces of information, and that's whether there'll be more pieces of information in there, but extract the information that you need, and what you're trying to do is calculate firstly what the fair value is and what the present value of the minimum lease payments are. So in terms of the cash flows for those, we've got 1, 2, 3, 4, 5 years. We've got a cash flow of 16.1, 16.1. So we've got a set of cash flows which are the regular payments in arrears, and then a payment at the end of $50 million. And the first step is to present value those at 7.5%. And if you do that, you'll find it is $100 million. So I would validate that at home, but it's $100 million. I think it's like $100 million and 45 cents, but you know, 45 cents on $100 million is neither here nor there. So we have this. We take the lower of the fair value and the present value of the minimum lease payments, which is the 100 million, which is what we've just got down here. And we end up with an entry on the 1st of July 2007 being the asset of 100 million and the lease liability of 100 million. If we were allowed to set these off, we wouldn't show anything at all. And that, again, as I said, defeats the purpose. And think about what we've ended up with as compared to a borrow and purchase situation. If we borrowed and purchased, we would have debited cash 100, credit liability 100. We'd have then debited asset 100, credited cash 100. Cash nets out. We don't have any cash left. We have an asset. We have a liability. And it looks just the same. Because that is what we've done. We've just basically borrowed money to buy this asset. Right, rolling down. We take that. This is the liability that we're dealing with. What you work out here comes down into the opening, just like what we did last week, just like what we did in week 6. And I mean, the results from the mid-semester for the debenture question were good. So I mean, it shows that you guys are by and large on top of that. So just it's the same thing. Put in the opening, put in whatever the cash flow is, which is a 16.1. Interest is the opening times the rate implicit, which is a 7.5%. You can see that right there. This is how much of that payment is being allocated to paying off the principal of the loan. So you've got $100 million, you paid off 16, the interest is 7.5. So that means obviously some of that 16 is going to be paying off the liability, and the lease liability closes at 91 million. That rolls down and repeat ad nauseum until you get to the final payment, which is the guaranteed residual, if there is one, and you're done. So this is for the liability. So when we talk about the lease amortization schedule, we're talking about the liability schedule. Lease liability amortization schedule is probably a good way to think about it. So this bit relates to the liability. This depreciation relates to the asset. So we've dealt with the liability, and we'll see that in this set of entries. The payment in year 1 is the 16.1. The lease expense is the interest component of that, or the finance charge, and the lease liability is the reduction in the principal. And that looks, not surprisingly, very, very similar to what we did last week and what we did in week 6. Now this is the liability, and this is the asset. Because not only do you have the subsequent measurement of the liability that you've created, we have the subsequent measurement of the asset. Now in this case, the depreciation is based on 20 years because we expect to keep the asset. So we look at 20 years with a 0 residual at the end of that, and we're just going to use straight line depreciation, and so we end up with, look, whether you call it amortization or depreciation, we're not really too fussed with, as long as it's one of the two. So lease amortization, credit some sort of accumulated amortization or depreciation, and that's based on the 100 million minus the 0, so the depreciable amount, over 20 gives you $5 million a year. And so we've dealt with the liability, we've dealt with the asset. At the final derecognition of the lease liability, so this, now just a comment, on this date there would be other entries there. There would be the entries for depreciation, there'd be the entries for this as well. We're just looking at, if you look at the requirements there, we're just looking at the final entry for derecognition. We're not looking at all the entries on that date. So if you're asking where these are, they would happen, but just to save space, we've only focused on this final bit, which is the final payment, because you're going to keep the asset. You debit the lease liability because you've now got rid of that $50 million, and you credit cash because you've paid that guaranteed residual. What you're left with is an asset on your books because you still have that non-current asset. You might change it out to becoming just property, plant, and equipment rather than leased asset, but you have an asset on your books being depreciated out as it has been just normally. You have a lease liability which is not there anymore because you paid it all, and you now own an asset. And there you go. That is doing a relatively straightforward finance lease. Now, I'm not going to flick back to the slides, but if you go to the next slide for operating leases. For operating leases for the lessee, lease payments under an operating lease shall be recognized as an expense on a straight line basis over the lease term, unless another systematic basis is more representative of the time pattern of the user's benefit. Literally, it is just debit lease expense, credit cash. So if we have a look at this example as to what would be different, if this was an operating lease, that wouldn't happen. You would not recognize an asset, you would not recognize a liability. So if I go down to Video Easy, the kiosk, not the actual store nowadays, and rent a DVD for $4, I am not putting an asset on my books. Even if I had books, which I don't, even as much as I find accounting interesting, I don't use accounting standards to do my personal finances. But I wouldn't put that on my books because that's not the type of lease that it is. So that wouldn't happen. Because that doesn't happen, you don't need to do this either. You don't have an asset, so you don't do the amortization. You wouldn't have a final, it's unlikely you'd have any sort of final payment. What would happen would be each year you would go debit expense or lease expense, 16.1, credit cash, 16.1. You do that for 5 years and that's it. So you can imagine if we're going to ask you a practical question on leases, it's not going to be an operating lease, because if you get that wrong, yeah, you've probably got other concerns other than the difference between an operating and finance lease. And on that note, before we get into lessors, before we get into sale and leaseback, and also before we look at another reason as to why companies prefer operating leases over finance leases, which is going to take some playing around on Excel, but it's something which I'll put up onto the online system so you can see that as well. But I think it's a really useful thing just to show you another reason why companies from a financial point of view would prefer an operating lease. We'll take a break for a couple of minutes and have a look at those three things and call it a night.